So this question is a step acquisition question. I've set out a pro forma, I've added in goodwill, and I've added in an NCI. The first thing that we need to determine is our group structure. And what we have here is our parent company, Traveller. Traveller bought 60% of data, and then on the last day of the year it bought a further 20%, so it ended up with 80% in total. It also had an investment in captive, and that investment in captive was 80%. Really essential that we determine our group structure at the outset of the question. What I'm going to do now is I'm going to work my way through the question line by line, just as I would do in any question. So the first thing that we have is PPE. So I've added the parent and the two subsidiary companies. Got a figure of 1869. We've got our investment in the subsidiaries. So I go down to my goodwill working, and I'm going to have a goodwill working for data and a goodwill working for captive. I'm just going to put in the cost of the shares, 820 and 541. That'll be worth a mark in the exam. Next, we've got our financial assets. Again, we're going to add these all together. So in terms of our financial assets, if I add them together, that gives me a figure of 138. We've got a net defined benefit asset of 72. I'm not quite sure what that is. I think that's something to do with the pension. Just slot it in at this particular stage. Current assets, add them together, 2126. So that's our total assets dealt with. When it comes to share capital, we've got the share capital of the parent is 1120. We then have our two investments. So I'm going to set up a net assets working for data and for captive. And for data, I'm going to have one set of figures for when we acquire 60%, another set of figures for 80%, and normally I'd then have a third column for the SFP date, but it just happens is that the SFP date is the same date that we take our investment up to 80%. With captive, it's going to be SFP and acquisition. So we have here share capital, 600, 600, 390, 390. And we've got retained earnings. I look at the figures in the statement of financial position. For data, it's 442. For captive, it's 169. Other components of equity, for data, it's 37, and for captive it's 45. I'm now going to do exactly the same for the parent company, but the parent company's reserves of course appear in group reserves. So I'll simply say here parent, and working number 5 is going to be a huge working, lots and lots of potential adjustments. So even by doing these things, we'll have probably picked up 2 or 3 marks already. So that's total equity dealt with. We've got current liabilities. Let's add our current liabilities together. And we've also got non-current liabilities. Non-current liabilities come to 851, and current liabilities come to 786. So I've now dealt with all of the information from the statement of financial position itself. Let's go through the extra information. On the 1st of December X0, Traveller acquired 60% of data for 600 million. Now here we have to be a little bit careful, because can you see that we've put into cost 820. What I'm going to do, I'm going to take out the second acquisition. The second acquisition cost me 220. Because again, it's a deduction. We look at the difference. So we must have bought the initial shares for 600, and the second acquisition of shares, which took us from 60% to 80%, cost us a further 220. What do I do with that 220? I take it out of my goodwill calculation. And what I'm going to do is I'm going to have working number 6, second acquisition in data. And all I'm going to do here is I'm going to go credit cash. We've spent 220 million, so I'm going to credit cash with that particular sum. So that's worth an extra mark if we've spotted that particular point. At acquisition, the fair value of the NCI was 395. So we go to the NCI, we're going to have an NCI for data and an NCI for captive. And I'm going to say at acquisition for data, 395 goes into my NCI calculation and also into my goodwill calculation, and that's worth another mark if we pick that up on the exam. Traveller wishes to use the full goodwill method. On the 1st of December X0, the fair value of the net assets was 935 and retained earnings were 299. So let's go up to our goodwill calculation, and we've got 299 is retained earnings. We know that the grand total comes to 935. We're also told that OCE is 26. If I add those three together, that gives me a figure of 925. So my fair value adjustment is 10 million. So if you do, you pick up another mark for that. And what are you going to do? I'm going to take that fair value and stick it into PPE. At the year end, this asset, oh sorry, I'm reading the wrong part. The excess in fair value is due to land, so there's no adjustment, there's no goodwill that we have to adjust for, so we can put in that fair value into our data calculations like so. It then says on the 30th of November X1, Traveller acquired a further 20% in data for 220 million. We've already calculated that, so that's just reassuring us that we've done our calculations correctly. On the 1st of December X0, Traveller acquired 80% of captive for 541. Well, we've already got that 541 in our calculations. The consideration comprised cash of 477 and the transfer of land with a fair value of 64. Quickly add those two together and that gives us 541. The carrying amount of the land was 56. At the year end, this asset was still included in non-current assets and the sale proceeds had been credited to profit and loss. Well, that's crazy because we've transferred it at a value of 64. Its value was only 56. So we need to make sure we get this right. So what I'm going to do here is I'm going to, first of all, I'm going to take it out of PPE because it shouldn't be in there. We've given that to the shareholders of the other company. So I'm going to take that out. At the value of 56. And I'm also going to take 56 off profit because can you see that if we've credited the full 64 to profit and loss, that's far too much. We should only credit to profit and loss the profit on the disposal. How much was the profit on disposal? It was 8. So therefore I've got to go from a profit of 64 to a profit of 8. I'm going to reduce profits by 56. If we pop down to group profits, land 56, like so. And again, there's another marker we managed to pick that up. Again, tricky stuff. at the date of acquisition, the net assets have a fair value of 526. Yet we know that the examiner likes to tell us the net assets. So we know how our working's going to be set out. So we've got here a figure of 526. Retained earnings were 90, so I stick in a figure of 90, and OCE is 24, so I stick in a figure of 24. Again, we'll pick up a mark for that. Add those together. What do we get? Well, that adds up to 504, so our fair value adjustment is 22. The excess in fair value, again, is due to land. If I'm increasing equity, I've also got to increase assets by 22. So we pick up another mark. Or every time we're doing this, we're picking up marks as we go through the question. This acquisition was accounted for using the partial goodwill method. It is acceptable to use both methods. You choose the method for each individual subsidiary. Note 3, goodwill was impairment tested and the recoverable amount of data was 1099 and that of captive was 700 million. Now, what I'm going to do here is I'm just going to put a little OS, a little outstanding by note 3. I'm going to come back to that later because we've not calculated goodwill yet. Note 4, we've got the financial assets. So I'm going to set up a new working. In respect of financial assets, the borrower was in financial difficulties and its credit rating had been downgraded. The difficulties indicate an impairment review is needed. The present value of the cash flows are, and we always discount at the original interest rate. Okay, so the present value of the cash flows, what are they going to be? We expect to receive 8 million in 1 year's time, and we're discounting at 1.067%, sorry, 6.7%, 8 million in 2 years' time, so 6.7% twice, and 8 million in 3 years' time, so discount by 6.7% 3 times. If I work that out, that gives me a figure of 21.12 million. The value in the SFP, we are told, is 29 million. So our impairment is 7.88 million. Now it says in the question, traveller wishes to value the loan at fair value. We cannot move from amortized cost to the fair value model because the business model has not changed. This is an issue per IFRS 9. We're still intending to collect the cash flows, so therefore the business model has not changed. If I've got an impairment of 7.88, what am I going to do with that? Well, I'm going to credit the investment and I'm going to debit reserves. That's my impairment. So what I'm going to do is go up to working number 5, financial asset impair from working number 7. I'm going to reduce that value by 7.8 million. Every time you put through an adjustment when you're working one of these questions, you've got to think of the debits and the credits. So I'm also going to go up to financial assets less 7.88 from working number 7. Next we move on to note 5. And it's always worth going through these notes because note 5 is actually quite friendly by the examiner standards. It's a depreciation calculation. We've not yet calculated depreciation, but we've got a split asset. So all I'm going to say is that we've got the roof of the asset. The roof of the asset's worth 5 million. But because it's a flat roof, we're going to spread that over 5 years. So that's 1 million depreciation. And then we have the factory. Now, the factory in total cost us 50 million, of which 5 million was the roof. So the remainder of the factory is worth 45 million, less the residual value of 2 million, and we're going to spread that over 25 years, so that gives us a figure of 1.72 million, giving us a total depreciation charge of 2.72. Again, we'd pick up a mark in the exam if we do that. And when you depreciate, what do? Well, you debit income statement and you credit assets. So let's put that through as a journal. I'm going to go up to reserves, depreciation from working number 8 is 2.72 million, and I'm going to reduce the value of the asset itself. PPE less 2.72 million from working number 8. So that's note 5. Note 6. Note 6 is evil. Okay, there's no other way to describe it. You won't be familiar with the way it's been set out, but what I'm going to do here is I'm going to say, well, ultimately, what am I dealing with? I'm dealing with a pension. And at the start of the year, or the figure in my statement of financial position, I've got an asset of 72 million. Remember, if you look at the statement of financial position of the parent, we've got that net defined benefit asset of 72 million. Losses of 25 million are to be recognised. Remember, it says are to be recognised, means they haven't been recognised yet. So we're going to put through a loss in OCI. So that's going to reduce my pension asset. So that's going to be debit OCI, credit pension. So I go to OCI in reserves. That's other reserves. So pension. This is working number 9. I'm going to put through that loss through OCE like so. The aggregate of service cost and interest is 55 million. Well, what do you do with the service cost and the interest cost? You charge that to income statement. So that's going to be debit income statement, credit pension. So we go to our pension. Our income statement is 55 million, but it's not yet been put through our income statement. So if I've not put it through our income statement, I'm going to put that through group reserves. So if you remember the basics from the pension, you'll have picked up a couple of marks. Once for putting it through retained earnings and once for putting it through OCE. After consulting with the actuaries, the company reduced its contribution to the year for 45 million. The contribution, this is really sneaky, the contributions were paid on the 7th of December 20X1. When is our year end? It's the 30th of November. So we've not paid it. So we owe it. So we need to put it into current liabilities. So again, we pick up a market view spot, and it's just simply owing money. So put it into current liabilities. What do we do with contributions in our pension account? Well, the double entry is normally credit cash, debit pension. So I'd say contributions. And if you've done even half of that, you've actually done really well. It's really quite nasty the way that the information's been laid out. You've had to have your thinking caps on in respect of this question. It's a really tough one. So if I now take a look at this T account, I know that debits must equal credits. So it looks as if we've got a closing pension asset of 37. But if you are familiar with IAS 19, and now this next minute is a minute you'll never get back in your life. It's a nerd point, ladies and gentlemen. We always restrict the pension asset to the present value of the amounts refunded and recoverable. And that's what the examiner's mentioned here in the final sentence at the bottom of the question. The present value of the refunds and reductions so we're going to restrict the asset to 18 million. So therefore, what am I going to do is I'm going to reduce the pension asset by, I'd normally stick it in at a figure of 37, but I'm only going to stick it in at a figure of 18. So I'm going to reduce it by 19. What do we do with that reduction? We debit that to the income statement. So therefore that's going to flow through to retainer. That's a nerd point. I can assure you, of the 22,000 students around the planet who sat this exam, nobody mentioned it. So don't worry, don't waste your time getting disturbed by things like this. So let's just reflect what we're going to do in regard to that. I'm going to go up to my balance sheet, and I'm going to say here, working number 10, I'm now going to stick in the maximum asset that I'm allowed to. Remember, I said I'm going to restrict the asset to 18. And when it comes to reserves, pension restriction from working number 9, that pension restriction is 19. That's a really nerdy point. Don't get stressed by it. Don't waste time revising it. So we've now dealt with all of the information in the question. When you reach that point, where do you go to? Net assets. So we're going to stick to our basics. So if we look at net assets, at the SFP date, they're 1,089 and 626. We can work out the increases. OCE has increased by 11. Retained earnings have increased by 143. If we take a look at our other subsidiary, OCE has increased by 21. Retained earnings have increased by 79. We're now in a position to work out goodwill. We've got the NCI for data. For captive, how are we going to work it out? Well, at acquisition, net assets of 526. The NCI have 20%, so that works out as 105.2. So I'm also going to put that into my NCI calculation. Again, standard procedures, but it's all the time picking up another mark every time we do this. Less the net assets. Our net assets are 935 for data, and for captive they are 526. So we get a goodwill figure. Our goodwill figures are 60 and 120.2. Again, it's going to be worth a mark in the exam. We're picking up all the time. I'm now going to go back to note 3, which is our goodwill impairment, and this is unpleasant. There's always an unpleasant twist in the exam on a few occasions. Goodwill impairment. And we're doing this for data and for captive. So we say, well, what are the net assets at the SFP date? And we pick these figures up from working number 2. So for data, it's 1,089, and for captive, it's 626. But the total assets of the subsidiary are the individual assets, but you've got to add goodwill onto that as well, because goodwill is an asset of your subsidiary company. So we then say plus goodwill. Now for data, because we're using the full method, we take the figure that we've already calculated. Because under the full method, the goodwill represents the goodwill to the group and the goodwill to the NCI. For captive, we worked out goodwill to be 120.2, but that only represents the goodwill to the group. So it represents 80% of the total goodwill figure. So what we have to do here, and this is very bizarre, we have to gross up the goodwill to work out 100% of the goodwill. So if I gross it up, it gives me a figure of 150.3. We then take away from note 3 the recoverable amount. And it says in note 3 that the recoverable amount for data is 1,099 and the recoverable amount for captive is 700. Because the figures in the statement of financial position are greater than the recoverable amount, we have an impairment 50 for data and 76.3 for captive. Now again, in the exam, very few students will have got this far, and it's not an issue because you've already picked up enough marks to pass the question. If you are using the full method, then you split the goodwill between the group, who has 80%, and the NCI, who has 20%. So we split them at the SFP date in the ratio of 40 to 10. So what I'm going to do is I'm going to reduce. So I'm going to say here, goodwill impairment, working number 10. Remember, goodwill impairment goes through the income statement, so it will flow through to retained earnings. Goodwill impairment 10 for NCI of data. Next, we've got the goodwill impairment in respect of captive. We've got a figure of 76.3, but that represents the total goodwill impairment. But remember, because we are using the proportionate method, we only show a proportion of goodwill in the accounts, and that proportion is 80%. 80% works out as 61.04, so I'm going to write off a further 61.04 through the income statement, which again will flow through to group reserves. So we go up here, 61.04 from working number 10, goodwill impairment. So I can therefore put through these goodwill impairments against the goodwill figures in working number 3. This is incredibly cutting-edge advanced accounting. Don't worry, it's not going to determine whether you pass or fail the exam. So we go up here, and we've got goodwill. What was our impairment? Well, we've got 61.04. and 50. Both of those figures have come from working number 10. That leaves us with goodwill figures of 10 and 59.16, which gives us a grand total of 69.16. What am I going to do with that? I'm going to take that goodwill figure, 69.16, has come from working number 3, like so. We've now dealt with every single piece of the question. To be honest, I would have left that goodwill impairment probably right until the very end of the question, because I'd just looked at it in the exam and go, oh, don't like the look of that. There's other marks which are easier to earn. So let's see what else we can pick up in respect of this question. Well, we've got our very good friend, our net assets working. In respect of data, we've got a total increase of 154, so I'm going to go to my NCI calculation. Share since acquisition. So for data, what's it going to be? Well, it's going to be 40%, because remember, between the acquisition date and the SFP date, the NCI had 40% and the group had 60%. So it's going to be 40% of 154, which works out as 61.6. For captive, they're going to have 20%. How much has captive made? Captive has made 100, so therefore I'm going to add 20 on, like so. So we have a figure of 456.6. We're going to come back to that in just a sec. We've not quite finished this. We've also got to give the group its share of post-acquisition. So for data, it's going to be 60%, but remember, we need to split that between retained earnings and other components of profit. So that gives me figures of 85.8 and 6.6. For captive, it's going to be 80%. 80% of what? Well, retained earnings have increased by 79 and OCE has increased by 21. So we allocate our share of those increases, and that gives us figures of 63.2 and 16.8. Have we dealt with everything? Nearly. What have we not dealt with? It's the second acquisition in data. So we've credited cash 220. What's happened? When we acquired the second set of shares in data, the NCI decreased from 40% to 20%, didn't it? So I'm going to say the NCI at the second acquisition. What was the NCI? Well, we've calculated it as being 456.6. And they've got rid of 20% of their 40% investment. So that works out as 228.3. So therefore I'm going to credit reserves with 8.3. That adjustment is taken to other reserves. So second acquisition adjustment from working number 6, I'm going to add in 8.3 like so. Go up to the NCI. What have we just done? Adjustment in working number 6. I've reduced them by 228.3 to take them down to 228.3. If we look at captive, captive is 125.2. Add the two together. The NCI comes to 343.5, and that's the figure that I'm going to take to my consolidated statement of financial position. That's come from working number 4. I'm now going to add up group reserves, except if this was an exam, what's the chance of making at least one mistake? Pretty high. I probably wouldn't bother adding it up. I'd probably just say, look, I know I've made at least one mistake. I'm not going to bother. But if you do add that up, you get a figure of 973.36 and 66.7 for retained earnings and OCE. Those figures, of course, have to be transferred to the face of the statement of financial position. Retained earnings 973.36 from working number 5, OCE 66.7 from working number 5. Non-current liabilities haven't changed. Current liabilities, I've got 831. Add that up, 4185.56. Knees are trembling, eyes are closed. We're going to add up the other side of the balance sheet. It could be a long night. We're starting to pray. Let's see what we have here. It's getting really exciting, isn't it? Well, PPE, if I add that up, that comes to 1842.28. Financial assets, 130.12. The net defined benefit we've established as being 18. Current assets haven't changed, 2126. Add that up, 4185.56. And it all balances.